We are now moving on. We started off this morning's session with famed entrepreneur Peter Thiel. We're ending it with the president of the San Francisco Federal Reserve. So, what this next session, President Williams has indicated that he's going to give a relatively short presentation. He's going to leave a lot of time for questions. So, if you have questions, start thinking about them during the presentation. So it's now my pleasure to introduce John C. Williams. He is the president and CEO of the Federal Reserve Bank of San Francisco. He also serves on the Open Market Committee and that sets interest rates. He has obviously a very clear view into monetary policy, helps set monetary policy in this country. So could you please join me in welcoming President John C. Williams?
I am the only Fed president who actually makes reference to the Clash in my speeches, hence the music. So anyway, good afternoon. It's a pleasure to be here. I am going to keep my prepared remarks short because I think it's much more interesting and valuable to have a conversation. So I don't need to tell anyone who's in this room now that today that there's a lot of excitement around Fintech, all things Fintech. As you're also aware, and you've been hearing about in the last couple of days, that Fintech's getting a lot more attention from regulatory agencies, including the Fed, but not only here in the United States, but in other countries as well. So given all of that, all the things that are going on, both here in the Fintech world and in the regulatory agencies, I think this is a critically important time to have an open and active dialogue among all the people involved in order to better understand each other, better understand what our goals are, what we're trying to do, but also the concerns that people have. So again, I'm going to follow the spirit of that and keep my remarks short. Let's see if I regret that decision. We'll see. So my talk encompasses the dueling aspects of my job as a policymaker at the Fed. On the one hand, I'm the president of the San Francisco Fed, and of course, the Western United States is the center of the technological hub for the United States, and arguably that for the whole tech universe. On the other hand, I'm an economist, and they don't call economics a dismal science for nothing, and I'm compelled to think hard about what are the potential potholes that could be lining the road. So in thinking about Fintech, I kind of back up a step and think about what's the purpose of a financial or banking system. And so let me just give a couple remarks about kind of the basic purpose of a financial system, and also acknowledge that our system, our current system, has come up short in a number of ways in the past. So from an economist perspective, the financial system basically has two core purposes. First is to facilitate payments between buyers and sellers, okay? And the second is to to direct households and businesses' savings to the most productive uses or investments. So I'm here thinking about building houses, building infrastructure, funding education, expanding businesses. Now, this is a tall order, especially for a complex multi-layered economy like the US, and certain aspects of these goals have been particularly difficult to achieve, especially the ones to try to assure that the financial system is both efficient and resilient, and that it benefits everyone in our society. Now, Fintech does hold a lot of promise in tackling these long-standing challenges. And that's one of the reasons I think there's a lot of excitement here and around the world around using innovation to solve these problems. And of course, a lot of the people working on that are here in San Francisco today. But it's also a reason why I want to bring up a few of the potential risks. Now, let me be clear that people who come from regulatory agencies like me and my colleagues, we don't highlight potential downsides only because we're buzzkills. I mean, that's not the only reason we do it. There actually are reasons. We do it because we have to look at not only what's possible in the sense of the limitless options the new technology and innovation provides, but also what's possible in the sense of a policymaker's greatest concern, and that is the unintended consequence. So before I go any further, I need to make two important disclaimers. The first is a standard one anyone at the Fed uses, that my remarks reflect my own views and not necessarily those of anyone else in the Federal Reserve System. The second is more particular to this talk, and that is that as a president of the San Francisco Fed, I actually don't have any direct involvement or responsibility around writing guiding rules or regulations. So I won't be talking about specific regulations and how they should or shouldn't apply to fintech. Instead, again, I'm going to back up and lay out issues and questions that I think should be part of the ongoing conversation about how fintech can make our financial system and ultimately our economy more successful at achieving its fundamental goals. So let me get back to the duality, the two sides of this. The laws of innovation often mirror the laws of physics, and that is for every great stride, there's an equal and opposite risk. So again, don't think of regulators as being the people who are calling the cops on the party. We're really here to make sure that no one jumps off the roof. And while we always look for and see the potential in innovation, we also need to look at the other side of the coin. So as I said already, technology offers a lot of creative opportunities to improve the performance of the financial system and to remedy some of its shortcomings. And I think in that regard, it's important to emphasize that fintech's products address all four corners of a consumer's wallet. That's planning, spending, saving, and borrowing. And the products are often simple, they're easy to use, and they're delivered in ways that widen the overall consumer base, allowing more people to take advantage of them and to grab the first rung of the financial ladder. One of the most obvious and potentially most game-changing benefits is the ability to reach historically unbanked or underserved and economically disadvantaged communities. It's true in the US, where inequality and access to financial services have been perennial issues. It's also true for emerging economies, where large parts of the population are making that transition from subsistence level living to a more sustainable economic existence. And to my mind, this is an incredibly powerful and important aspect of it. So what can fintech do? It lowers costs, it can improve services, particularly for the lower income families and small businesses. It can help more people get access to credit at reasonable terms. It can better manage their finances and keep more money in their pockets. Or in case of many of the workers in the US who send remittances back home abroad, it means more money for the kids, for their parents and their communities. Similarly, fintech can help revitalize impoverished neighborhoods by allowing small businesses that have been shut out of the traditional financial sector to take root and to grow. And globally, we're seeing this happen. We're seeing the emergence of payment systems, for example, via mobile phones in places and countries where the vast majority of people don't have bank accounts. They do have cell phones, and so instead of paying huge fees for banking services, it's all done through a swipe or a few clicks. And this has caught on in some areas, as I mentioned. It's likely to gain more popularity across the globe in coming years. Now, this all sounds fantastic. This is amazing stuff going on, and it's awesome what the potential can be. And you've been talking about that last few days. So what's my problem? What can go wrong? Well, I think the flip side is the exact people that fintech is supposed to help could wind up being marginalized. So I think back in history to the exclusionary practices in lending, like redlining, where portions of the population were denied services based on where they lived. So it'd be a travesty to my mind if, despite the best of intentions of everyone involved, the new technologies designed to improve the availability of credit instead of reintroducing that kind of exclusion, say by basing decisions on zip codes or demographic factors. A similar juxtaposition of potential and risk arises with the proliferation of options for savings and borrowing that fintech promises. So novel approaches to intermediate savings and investments can lower costs. It can broaden access to people who are currently underserved. But at the same time, and we know from history that this is a recurring problem, that the unscrupulous will prey on the vulnerable, be it through predatory lending, irresponsible payday loans, or outright fraud. So again, I don't want to see fintech's positive potential hijacked to become a source of a new, more powerful platforms that prey on consumers on a massive scale. So another area for the great and possible is leveraging data, big data and data analytics to improve operational efficiency, risk management, and decision making. For example, sophisticated algorithms can help overcome many of the hurdles that defeat money laundering and the funding of terrorist and criminal organizations. So for example, know your customer laws all across the world require banks and financial institutions to verify the identity of the people they do business with. But this is a very costly and imperfect undertaking with today's technology. So advanced data analytics could provide more powerful tools and ways to increase both the efficiency and efficacies of these efforts. And that's I think, a very positive development. Of course, on the other side of the coin, again, there's that some aspects of Bitcoin, if left unbridled, could, due to anonymity and other aspects like digital currencies, have the potential to make criminal activity and terrorist activity easier. So while fintech can have significant benefits for the ability to assess and manage risk as well, anytime we're talking about big data, everyone needs to be vigilant about protecting the security and the privacy of that data. While fintech can also improve not just the accessibility, but the quality of service is something we all want, we also need to look out for the resilience of the financial system as a whole. It's a lesson that the financial crisis reminded us all too well. So as the fintech industry continues to grow, both at both at non-bank institutions and with all the partnerships with banks, we need to be vigilant about the potential risks to the financial system and realize that the risks expand in proportion. Moreover, for our financial system to be efficient, it's important that we have a level playing field across all the organizations, regardless of how institutions prefer to describe themselves or what kind of charter they hold. So as a matter of principle, if it walks like a duck, if it quacks like a duck, it should be regulated like a duck. So in raising these concerns, I'm not suggesting that the spirit of innovation is somehow nefarious, nor do I claim that I'm the first one to raise these issues. But I said earlier, it is about unintended consequences, and we have to pay close attention to that. In other words, it's not just about what you do, it's how you do it that also matters. So in summary, there's no question fintech is going to change the face of financial services on a global scale. I'm excited about these changes. They're happening around us. And I do see, as a native California, the potency of the possible. But for fintech's potential truly to be met, we need to make sure that we don't reinvent shortcomings that have plagued our financial system in the past. And in that regard, well-designed regulation that protects consumers, that fosters inclusionary rather than exclusionary practices, and enhances the fairness and resilience of the financial system actually should help rather than hinder fintech's contribution to creating a better financial system and a better economy. Thank you.
So we'll be happy to take some questions if you want to go to the microphone. We have our first one over here.
Hi. It seems recently there has been a shift in Fed members with regard to their positioning on concerns with regard to the global economy and how much of an impact it should have on Federal Reserve deliberations. You yourself, for example, last year seemed to downplay any weakness in the Chinese economy, yet more recently you've talked about the necessity for the Federal Reserve to consider what's going on in the Chinese and Brazilian economy. At the same time, you've also seemed to have backed away, again, all the members, but you yourself particularly, with regard to some comment that there's a possibility the Fed might increase interest rates in April. And now that seems to be backed away from. Jim Rickards has suggested that some kind of deal was made at the recent G20 meeting in Shanghai where Fed Chair Janet Yellen and other central bankers agreed to weaken the dollar versus the yen and the euro to benefit the Chinese economy. Can you address this? What is the reason for the seeming shift in concern about global economies, and was some kind of deal reached at the G20?
So these are a lot of different questions, and I agree with the point that you made in my past speeches. I have been less concerned about a hard landing in China, and that view hasn't changed. So I'm basically in the same place I was late last year when I talked about that. In terms of global conditions affecting the U.S. economy and therefore affecting monetary policy, I always think about it throughout this through the same lens, and that is, we're in a global economy, we're in a global financial system. Obviously, what happens abroad affects our exports, it affects our economy, affects the value of the dollar, affects inflation in the U.S. economy. So we have to take all of that into account. But the monetary policy decisions are really based on what's it mean for our two goals, maximum employment and price stability. So I just take all that information about what's happening abroad, the risks of the situation abroad, feed that through and to say, well, what's that mean for where we are in terms of full employment and getting to our 2% inflation goal that we've been missing for the last several years. So I don't think any of that has fundamentally changed. I think that what we saw last summer and early this year was just a lot of concerns out there in the market about what's happening not just in China, not just in Brazil, but in Europe and Japan and other places. That pushes the value of the US dollar up. That obviously causes our inflation rate to go down because import goods are cheaper. It also slows our growth because of it's harder to sell goods abroad because the dollar is so strong. So we have to take all that into account. But just in that way, through this kind of just standard mechanisms by which global conditions affect the U.S. economy. There's no deal about monetary policy. When we go in there to talk about monetary policy, we look at where we are in our goals, what's the outlook look like, what are the risks of the outlook, and what's the best monetary policy decisions that will most likely help us achieve those goals in the next couple of years. I think the U.S. economy is actually doing quite well. Unemployment's 5%. We're adding on pace to add about 2.5 million jobs this year. Obviously, around here, it's doing even better than that. But nationally, we're doing well, and inflation's moving back to 2%. So I think we're actually in a good place relative to the global factors. The global factors are obviously one of the reasons why we're not growing faster and we're not getting back to our goals as fast as we would like. But again, it's our policy decisions are based on what's happened in the U.S. economy. And really, when we talk about the situation abroad, it's because it feeds back into the U.S. economy, not for other reasons.
So there was no drive or agreement at the G20 to weaken the dollar?
I'm not on the G20, so I should just not answer questions about things I'm not involved in. But I will tell you, at the FOMC, where we make the monetary policy decisions, the focus there is how are we doing on our goals and what's the best monetary policy for the U.S. economy to reach our goals.
Okay.
Hi. Question about...
This is hard to see.
Yeah, sorry. We've talked a lot about regulation throughout the conference, but was curious if there's been talk about incentives for marketplace lenders and private investors to work in underserved communities. So things like New Markets Program, low-income tax credits, ways to kind of bring the community development field closer to the marketplace lending field.
So it's a great question. I'm hoping that we're going to see more and more of that. I mean, one of the things I've been working closely with my colleagues at the Fed in the last couple of years is really around this community development area, about how our efforts at the San Francisco Fed to bring together local governments, community groups, lenders, mostly banks, as you're saying, and finding ways to find creative solutions around revitalizing downtowns, helping economically distressed areas do better and all that. So there's a lot of work going on there, but a lot of it in the past has been focused on kind of the CRA, the Community Reinvestment Act, requirements of banks and things like that. So what we're seeing now is kind of an evolution where I think some of the non-traditional or non-bank institutions are coming in. We definitely see more involvement with non-commercial bank institutions who are interested in these goals, these double or triple bottom line goals. We're also seeing this with creative financing through social impact bonds and things like that. So I think that world is changing in ways that are beneficial to bring kind of more investor community into this, and I think bringing, as you said, getting those parties who want to make small business loans or other types of activities, getting them involved in this is the obvious next step, which I think should happen.
Thank you.
Yeah.
Hi. Good morning. Thank you for your presentation. My name is Julian Guarino. I am from Argentina, and I want to ask you, what do you think is going to happen with Latin American economies and Latin American currencies when the Federal Reserve decide to increase rates?
So,
do you think our economies prepared for that?
Well, I think that the Fed has spent the last few years talking about nothing but the fact that we're going to be raising interest rates as the U.S. economy improves. So this is the most telegraphed, worst kept secret, if you will, in monetary policy circles. So when we raised rates in December, we didn't actually see negative impacts in emerging market countries or South American countries directly from that. What we have seen in the past, I think, to answer your question a little bit more directly, is that when monetary policy is shifting in the U.S. Clearly, countries who are struggling with their own economic problems for whatever reason, who don't have their own house in order, can see big capital flows out of the country. So that's the biggest fear I would have for emerging market countries that really already got issues that they're, whether fiscal policy issues or capital account issues, they're the ones that tend to see the money fly out when interest rates get higher in other places. Quite honestly, again, going back to the December experience, we're not, and even since then, we're not seeing these big capital flight out of these countries as the Fed is not only started talking about raising interest rates and has started raising interest rates, but I wouldn't, I think that, it's a global financial system, and there are countries such as Brazil and Venezuela and others who are, who have a lot of difficulties, and so they'll probably get impacted in more than countries that I think are kind of in a better having their house better in order. The thing that the Fed's doing now to kind of relate the two questions is, we're driving monetary policy based on what's happened in the U.S. economy, but we're trying to do it in a transparent and a kind of easy to understand way that so that countries around the world can prepare, can understand what the likely path of policy is going to be, and do their best to prepare for that. So when I meet with leaders around the world, they all say, we know the interest rates are going to go up. We know this is going to have some impact for us, but we're getting our situation as best as we can prepared for that. Unfortunately, there are some countries who've because of the big decline in commodity prices, they've got a lot of struggles that are happening regardless of what the Fed does.
Is this on? Okay. I was hoping you could talk a little bit about, from a systemic risk standpoint, if you worry about any portion of the non-bank finance sector, and at what point does marketplace lending have a footprint in that?
Yeah, so the answer is yes. I worry about non-bank, financial system in terms of systemic risk. If you look at the financial crisis, 2007-8, these were the big names were non-banks or investment banks and AIG insurance company and things like that, mutual fund. So clearly we need to, and we are focused at the Fed not only on commercial banks but also on the systemically important financial institutions. Everyone's focused on understanding the interconnectedness of our financial system. In terms of fintech, in terms of marketplace lenders, the thing that the good news here is that it's still relatively small in absolute scale compared to the size of the financial system, compared to the overall financial system. So from a financial stability systemic risk, I think right now it's pretty small, not really on the radar. My prepared comments, I mentioned just that if it does continue to grow at these double-digit rates, it continues to become, or as it gets to be a more important part of both the economy and with the connections with banks, obviously it just moves up that list of things we have to be paying attention to. But when you're in the in the tens of billions of dollars or even $100 billion realm, you're still talking about a pretty small slice of the financial system today.
Is there any part of non-bank finance that worries you most this cycle?
Sure. So, I think that the thing you worry about is runs in the financial system. So, commercial banks are, regular banks, the the banks you think of, they have retail deposits. They get people who are putting, like me and you, putting their money in the account every day, businesses, households. So a lot of their funding is pretty stable. Investment banks still rely primarily on, wholesale funding, repos and things like that. And in a financial crisis like we saw in 2008, those markets can dry up overnight. So, I think that's one area in the non-banking area that we really need to see continued, progress to make our financial system less prone to sudden stops and kind of markets freezing up. So that's one area they're working on a lot in terms of making sure you have liquidity, making sure you have, obviously capital liquidity, but basically can survive a sudden kind of drying up of liquidity in the markets.
Thank you.
Hi, I'm Kim Leslie Schaefer. Thank you for your thoughtful remarks on both the promise and risks of fintech. Aside from future SIFIs and potential systemic risks, do you see any current, given that fintech companies, marketplace lenders are not deposit taking, do you see gaps in current regulation that need to be filled?
I think it's a great question, and I swore off in my remarks that I was going to try to get away from the specifics of regulation. First of all, it's not, my expertise to understand all of the different aspects of, truth in lending and all of that. But I think that the principles I think that we should be following is the ones that I talked about, is making sure that we have very strong protection for consumers. We basically, because we have a system that is inclusive to all parts of our society. So I think that's something that people need to be looking at in terms of, if this kind of marketplace lending and these kind of aspects grow and grow, and traditional commercial banks become less of a role, then we're going to have to make sure that our financial system is actually delivering for all Americans, and of course protecting people from, as I said, from being preyed on by others. So I think this is something I know that my colleagues around the regulatory system are thinking about. We're kind of in that mode of, I think, learning, understanding better of what's happening, what's really, how these things work. I'll tell you something about this. You go to the websites, or even go into the room across the hall, it's all like, oh, we're doing this. It's not completely clear, we're providing credit to people. So we really want to understand at a deeper level, have these conversations and interactions so that I think have a better picture of this. But I think down the road, obviously, consumer protection, these kind of things are things we want to make sure applied across the board.
Hey, thank you for your comments. I had a question. Given what's happened with monetary policy, rates near zero, QE pushing up asset prices, and Peter Thiel this morning was talking about sort of a bubble in cash. My question is, a lot of what you guys have traditionally done is supposed to encourage banks to lend, and yet banks haven't been lending a lot, or if they are lending, they're lending to people who are just going into share buybacks and sort of cycling through the financial world, but not as much in the real economy. How much do you see fintech, marketplace lending as a tool to potentially address that? Is that something the Fed would be supportive of? I'm just curious how your thoughts on that.
So, welcome to my life, I think is how I answer your question. One is, monetary policy is just an incredibly blunt instrument, right? When it sounds complicated, and we do a lot of analysis and sophisticated modeling and all of that. But in the end, do we raise or lower interest rates? And as we got near zero, that was, we're kind of like, do we just keep interest rates at the same level? So we don't have a lot of tools that we can affect the economy. And you're absolutely right that to the extent that if we lower interest rates and people are less willing to lend, or people are less willing to borrow because of the debt overhang that they've experienced, we can't change that. It's only, we can just affect the amount of liquidity in the system. We can affect the interest rates, but it's up to people to decide whether to borrow and lend. And clearly, after the financial crisis, we can see this in the data. We know that lenders, banks, were less willing to lend except to the highest quality, highest FICO scores, highest quality borrowers. We see that even today in mortgage lending. If you look at the data and all the mortgages being issued now, it's still the case that very few people that don't have pristine FICO scores and histories are getting access to mortgages. So all those things are relevant in terms of understanding what we think of as a monetary transmission mechanism, and a better functioning financial system that basically does a better job of the things I said, specifically allocating savings to investment, would actually make monetary policy more powerful, more effective, and I think more predictable. So there's clearly, we're now in a situation, we were in a situation where we were in early 2000s, where you could get credit as long as you had a pulse. And so that was too much. Now we're in a situation where credit is still quite, I think, restricted in ability to, both from a supply side, but also from the demand side. And that is kind of making if you think about our monetary policy engine only running on 4 cylinders instead of 8. And so having a stronger, more robust financial system that includes lots of different parties doing these kind of things, I think actually can improve both the the success of the economy, but also make monetary policy more effective. Now, the other thing I will say is this has been helping us a lot in kind of a way that people probably wouldn't expect. So our financial system is not just banks, right? Much of, if not the majority of the credit is through the non-banks, through capital markets, through stock markets, through bond markets, through private equity and things like that. All of that has actually been there at the same time that the banks got struggled from the financial crisis. So because we already have kind of a diversified financial system, and actually I think has made it better for us in terms of the economic recovery. If you look at Europe, their financial system is still primarily commercial banking, and so as the commercial banks have struggled, I think monetary policy has gotten less traction there than we have in the U.S. So again, I think a diversified, robust financial system is good for a lot of reasons, including helping monetary policy have a bigger effect.
Okay, I think we're out of time. Thank you very much.
Great. Thank you.
Thanks, John. Really appreciate it.